What should I invest in? Should I just buy the S&P? I get asked these questions all the time. What I will say is that before you invest in anything, it's important to understand what your risk tolerance is and why you're buying what you're actually buying. Today we're going to break down some of the most important indexes. We're going to go with the S&P 500, the Dow Jones Industrial Average, the Nasdaq Composite, and we're going to get into the Russell Indexes 2000 and 3000. In our next video, we're going to go with we're going to start with the MSCI EFA, the MSCI Emerging Market Indices. We're going to break down the Nikkei 225, the Eurostoxx 50 and the Eurostoxx 600, the Bloomberg Aggregate, and the FTSE 100. All right, let's get into it. By definition, a market index allows investors to trade, track, and analyze the performance of a specific weighted group of securities. These indexes represent particular sectors, regions, or markets. The purpose of these indexes is to measure the overall direction of the market, up or down, rather than the performance of a single company. An index fund, or an ETF, is managed passively, which aims to maximize returns by minimizing costs of buying and selling securities. Investors use passive investing to buy securities representing a benchmark, using mutual funds or ETFs that mimic the holdings in the index. Portfolio managers do not have to actively hunt for investments. For example, one of the most well-known indexes or indices is the S&P 500 or the Standard & Poor 500 index. Again, the S&P stands for Standard & Poor's, which is a capitalization weighted index of 500 stocks designed to measure performance of the broad domestic economy through changes in the aggregate market value of 500 stocks representing all major industries. What this means essentially is that from year to year, you are either one of the largest companies, one of the largest 500 companies in the country, or you're not. A manager doesn't have to decide which companies to put in the fund because it is done automatically, and because of that, there are lower fees. By contrast, there are also active portfolios where managers aim to outperform a benchmark index through frequent research-driven trading. Hence, they are hunting for companies they feel might beat the benchmark annual rate of return, offering potentially higher returns but at greater cost and risk. Passive portfolios are more of a buy and hold strategy to match market returns, whereas active management seeks to buy and sell more frequently, looking for better returns, such as sector rotation, which shifts capital between different sectors to capitalize on changing economic cycles. Before we get into the indexes, I want to talk about how a company is capitalized. And this is important because certain indexes will only choose companies based on their market capitalization. A company can be considered, for the purposes of this video, we'll just keep it simple and say a company can be considered large, mid, or small. Yes, there's also mega and micro, but again, we'll focus on the large, mid, and small cap companies and how they are capitalized. To understand a company's capitalization, multiply the number of a company's shares outstanding by its stock price per share. Large cap stocks have a market capitalization of US 10 billion or more. So for example, if a company's stock price is $100 per share and there are 100 million shares in the marketplace, that company's capitalization would be US 10 billion. A mid-cap company is from 2 billion to 10 billion, and a small-cap company is capitalized from 300 million to 2 billion. There are some variances to these numbers, but we'll keep these numbers here for now. Mega-cap companies are 200 billion or more, and micro-cap companies are between 50 and 300 million. Just know that these numbers are pretty straightforward. Sometimes, though, theoretically, a small-cap company could be capitalized at a little above 2 billion. It does happen. Keep that in mind. The S&P 500, as mentioned, is a group of 500 companies that are the largest capitalized companies in the U.S. Investing in large cap stocks is seen as a long-term strategy due to stability, often paying dividends due to their established markets. Getting into the S&P 500 is done by meeting strict criteria. The current market cap to be included into the S&P 500 is currently US $22.7 billion. As of January 2026, the top 10 companies in the index are NVIDIA, Alphabet, Apple, Microsoft, Amazon, Broadcom, Meta Platforms, Tesla, Berkshire Hathaway, and Lilly. Companies that have increased their dividends in 25 consecutive years are known as the S&P 500 Dividend Aristocrats. Remember, large cap companies were once small cap companies. Next, we have the Dow Jones Industrial Average, or simply the Dow. The Dow Jones Industrial Average is comprised of 30 stocks that are major factors in their industries and widely held by individuals and institutional investors. This index is price weighted, meaning instead of the company's market capitalization, each company makes up a fraction of the index that is proportional to its price. For example, a stock trading at $100 will make up 10 times more weight of the total index compared to a stock trading at 10. Because there are only 30 companies, this could heighten risk due to stock concentration. The index was created by Charles Dow and is the second oldest index among U.S. market indices. At present, Goldman Sachs has the highest weighting, followed by Microsoft and Home Depot. Companies in the Dow are large cap, blue chip U.S. companies with excellent reputations and sustained growth. Blue chip companies are large, established companies that are financially stable with a reputation for quality management and profitability. They pay regular dividends and have high credit ratings. Next, we have NASDAQ. NASDAQ is the second largest exchange by market capitalization and is the first fully electronic stock market. The NASDAQ Composite Index measures all NASDAQ domestic and non-US based common stocks listed on the NASDAQ stock market. The market value, the last sale price multiplied by total shares outstanding, is calculated throughout the trading day and is related to the total value of the index. The exchange is primarily for technology companies, but also trades in many foreign firms. As mentioned, don't worry about all the subgroups. Within the NASDAQ composite is the NASDAQ 100, which includes the largest non-financial companies in the NASDAQ composite. The following security types are traded: ADRs, which are American Depository Receipts, common stock, limited partnerships, and REITs. Technology makes up about 62% of the index, followed by consumer discretionary at 19% and healthcare at 6%. The Russell 3000, established in 1984, is an index that measures performance of the largest 3,000 companies in the U.S., representing approximately 96% of the investable U.S. equity market. The Russell 3000 Growth Index is an unmanaged index comprised of those Russell 3000 companies with higher price-to-book ratios and higher forecasted growth values. The Russell 3000 Value Index measures the performance of those Russell 3000 companies with lower price-to-book ratios and lower forecasted growth values. The top sectors are technology, consumer discretionary, industrials, financials, and healthcare. Next, we have the Russell 2000 Index, which is an unmanaged index generally representative of the 2,000 smallest companies in the Russell 3000 Index, which represents approximately 10% of the total market capitalization of the Russell 3000 Index. So again, the Russell 2000 are primarily small cap companies. You might have a few mid cap, but primarily small. In this index, the heaviest weighted sectors are financials, industrials, IT, and healthcare. Ladies and gentlemen, thank you for being here with us today. And again, don't forget to hit subscribe. Check out my Instagram, check out my Facebook, and again, here at YouTube at A Blank Canvas. Thanks for your participation and look forward to seeing you next time. Take care, everybody. Bye-bye. Grazie. Jeffrey Blanc is a financial planner with and offers securities and investment advisory services through LPL Enterprise, LPLE, a registered investment advisor, member FINRA SIPC, and affiliate of LPL Financial. Prudential Advisors is a brand name for the proprietary retail sales channel of the Prudential Insurance Company of America and its insurance company and other affiliates, collectively Prudential. Prudential Advisors financial professionals are licensed agents of Prudential. Pursuant to a strategic relationship among Prudential, LPLE, and LPL Financial, Prudential Advisors financial professionals provide securities brokerage services and/or investment advice on securities solely as registered persons of LPLE, an affiliate of LPL Financial. These financial professionals are permitted to brand under Prudential Advisors. LPLE and LPL Financial are not affiliated with Prudential. RICP conferred by the American College.